When does it make sense to buy your house? I introduce you to the rule of 150. The rule of 150 says that you can multiply your estimated monthly mortgage payment by 150% to get your actual out-of-pocket costs of ownership. As in, this is how much your home will actually cost per month once all of these expenses are factored in. So it's like a handy little tool. If that rule of 150 monthly cost is higher than your rent, then it makes sense to rent. And if it's lower, then it makes sense to buy. A $500,000 home would suggest a $100,000 down payment, so 20% of its total value, to avoid private mortgage insurance, which means that you would be mortgaging the other $400,000. According to Bankrate, as of August 2022, the average U.S. mortgage rate for a 30-year fixed mortgage was 5.95%. That's $2,385 for your mortgage payment and $1,253 in taxes, insurance, and routine maintenance using all national averages, or $3,638 per month. That is an average monthly cost of roughly $1,253 toward what we call unrecoverable costs, or costs that do not build any equity, in the same way that rent builds no equity. So the average American family, right? They live in their home for 13 years rather than for the full duration of, say, a 15 or 30-year mortgage. So most American families never outright own the house that they live in. So today, we're going to use 13 years as the timeline. For context, this average has increased in recent years. Back in 2010, for example, it was about 8 years. So let's see if our example checks out. What was our cost breakdown over a 13-year window, excluding closing costs and major renovations? It was $195K on insurance, taxes, maintenance, the extras, and then $372K on principal and interest, the main course. So 195K divided by 372, you get 52%. So in our case, our extras accounted for 52% of our main course, the monthly mortgage payment. So taking your mortgage monthly payment that you are looking at, right, for the house that you want to buy, the rate that you can get, and multiplying it by 1.52 would have given you the actual total all-in costs that account for things like insurance, taxes, maintenance. Again, we're not including the down payment in this. So calculate your monthly payment on that mortgage you could get for the house you want to live in. Feel like you could afford it. Multiply by 1.52. If the rent you are paying now is higher than that number, it makes sense for you to buy, assuming that you have your down payment or that you can factor in the PMI costs for a sub 20% down payment. But if your rent is less than that number, it actually makes more sense to rent and invest. So for example, unless our rent for something comparable currently exceeds $36.25, which is $23.85 times, you guessed it, 1.52, it makes more sense to keep renting. If our rent for something comparable is, say, $4,000 per month, and you could own that same or a similar piece of property for $500K, and you cannot fathom living in anything that costs less than $500,000, then it makes more sense to buy than to keep on renting at $4,000 per month. So remember, it's not like I'm suggesting that you start your family of 5 in like a studio apartment. I just want you to run the numbers and see if owning or renting a home makes more sense in your market. Because you may find that even if you think, oh God, we actually might come out with a net loss here, you might be okay with that if you are really interested in the benefits of like long-term stability that ownership can bring. Not every decision has to make financial sense. It's just important to know what you're getting yourself into when you sign on the dotted line for a loan whose name loosely translates to death pact. Buying a small 2-bedroom home that is well within your means will definitely end up being better in the long run if you are currently renting the penthouse at the W. The problem is that most people do not go from the penthouse to the tiny house. They go from the 1-bedroom apartment to the 3-bedroom home in the suburbs.